Hello, welcome to Strictly Money, where all voices matter. I'm your host, Saijal Patel. Markets are no doubt facing interesting times. On one hand, investors are grappling with increasing geopolitical risks, even greater inflationary pressures, and rising bond yields. On the flip side, though, North American economy appears to be fairly resilient, at least so far. So many wait and wonder if the other shoe will drop and what will trigger it. To help us unpack all of this in his insights is Philip Petursson, Chief Investment Strategist with IGM Financial. Philip, it's great to have you back.
Great to be here, Saijal. Thank you for having me on.
So, Phil, if it does feel like there's a lot of unknowns, lots to unpack, as I said. What, if anything, is making you nervous right now?
It's a great question. We've seen a very interesting quarter in terms of market activity that was compounded by the geopolitical risk that we saw between Russia and the Ukraine that's still going on. I would say there's not a lot that I'm overly nervous about right now. I think the market is perhaps putting too much emphasis on some data sets that are coming out or some little factors that they're extrapolating into recession risk or greater economic risk, globally. But when I look at the fundamentals, I'm not seeing that. So largely, I'm actually quite confident in the market as we go forward. I think we know the outcome for the fixed income markets. I have a confident outcome for the equity markets over the remainder of 2022 and into 2023. It's really, when I start to think about some of the risks, it's really in the back half of 2023 or 2024, following all the interest rate increases by the Bank of Canada or the Federal Reserve, that I start to think, okay, I know it takes a while for monetary policy to impact economies. Therefore, what we're seeing today out of the Bank of Canada won't impact the market today or tomorrow or next month. It'll take into 2023. So that's what I'm thinking about. And right now, there isn't a clear picture on where we're headed.
Okay, so you think that impact is going to be a little bit later. Then how big of a headwind, Philip, is inflation still? It wasn't that long ago that the thinking was most of this is transitory because of the supply disruptions. Should we be thinking about this differently now?
Well, I think those that took inflation lightly in 2021 and didn't really understand how the inflation was created do need to rethink their position. So if we went back a year, I was fighting against the transitory narrative, saying, no, it's not going to be transitory. When you flood the global economy with as much liquidity, cash that we saw, 16 trillion was roughly the amount that we saw global central banks and governments inject into the economy, that is going to have consequences. And the consequences of that are higher inflation. So it wasn't used cars that some people were talking about, or airfares, or supply chains. Those were all excuses to mask the real driver of inflation, which is a massive increase in the money supply. So inflation is going to be with us for a while. You have to think of inflation as a locomotive, like a big train. It takes a while to get going, but once it gets going, momentum keeps it in a direction, and it takes a while to slow it down. So the central banks are fully aware that inflation now is more persistent. In fact, I actually think the central banks were on the side of persistent inflation, but they couldn't say it. They had to be very careful in terms of what they said. They had to wait for the market to accept it before they could acknowledge it. Now we're at the point where the central banks are acknowledging it. They're raising rates to temper inflation. I do think they will do a good job of it. I do think that we will see lower inflation, but we're not going back to sub 2% that we saw over the last 10 years. It's probably going to stay in the range of 3 to 4% inflation, for the next, I think, couple of years until we continue to unwind all this monetary stimulus.
Philip, we only have about 45 seconds to the commercial break. On that inflation front, though, do you think that raising rates will actually fix the demand side? Because it just feels like the demand side is really on the essentials that we need.
Yes. Look, I think it will. And I think any reduction or softening of demand or removal of liquidity will have the impact of reducing overall inflation. But again, it's going to take some time. So, the argument is, well, what is the Bank of Canada going to do by raising rates to the cost of oil? Directly, nothing. Indirectly, yes, there are second and third derivatives of that interest rate increase that eventually will work its way into demand in many areas, including oil demand, that should soften that price.
All right, we're going to take a quick commercial break. We'll be right back. Welcome back. Philip, before the break, we were talking about inflation. When you think about the Bank of Canada and the Fed, what do you think their greatest challenge is? I know you said that you think they're going to do a good job, but I guess if you were in their shoes, what would you be paying most attention to?
Okay, so we have to recognize that the Bank of Canada and the Federal Reserve are perhaps behind the curve. In my view, I think they are a little late to raising interest rates. I think they should have done it earlier. As soon as economies started to open up, the Canadian economy, the US economy started to open up, they should have removed the emergency stimulus at that point. Yeah. Nonetheless, we are where we are today. I think what they need to be careful about is balancing the interest rate increases to get to a level that if they do run into some slower economic growth, that they have levers to pull to stimulate the economy again. What that means is they have to get rates up fast enough to have something to cut, but also not too fast that they're going to really slow down the Canadian economy or the US economy and send us into recession. Usually it's a central bank policy mistake that leads or contributes to recessionary outcomes. I don't think that's going to be the case this go around, but the Fed and the Bank of Canada need to be aware of that, need to be measured, but not too slow and also not too fast.
Yeah.
I don't envy them for that challenge.
No. It's interesting that you said you think they're behind the curve. And I've always wondered, do you think they're afraid of the impact of the markets? I always feel like, I always think like, who's controlling who here? Sometimes the markets react and they're like, whoa, we have to appease to the markets. And sometimes I don't feel they're as independent. Like, do you see that?
I do. It seems that they do walk that line. And I don't necessarily think that Federal Chair Powell is saying, well, I need to support the equity markets. But I think they understand that the wealth effect can impact economic growth. Yeah. So they don't necessarily want to trigger a market correction or crash because they know what that means for the broader economy. Not that a downturn in the stock market will result in a recession. That's not the case. But it can influence consumption if we started to see prices fall. In this case, what it sounds like out of both the Bank of Canada and the Federal Reserve is that no, inflation is our focus and we will do whatever it takes to rein inflation in, letting the markets know, look, don't lean on us to support the equity markets higher if we start to run into volatility. We're not playing that game today.
Okay. So the next meeting, at least the Bank of Canada meeting, is April 13th, and most are expecting a more aggressive, I guess, half-point increase. Is that what you're expecting?
Yes, I think that, and I think it's a good move. So I do think that the Bank of Canada is going to be aggressive early on. I think the Federal Reserve is going to be aggressive early on. And it's better to do it now when the economy is in a good position to absorb it, so that, again, down the road, if they have to cut rates, well, if I'm only going 25 basis points at a time, well, I might not have rates high enough to make a meaningful impact for a cut late in 2023 or 2024. If we go 50 basis points now, 50 basis points the next meeting after that, well, we've removed a lot of that emergency stimulus right away. And it gives us the ability to pause at that point or down the road, cut if needed.
Yeah, you mentioned, the economy is fairly resilient. You look at retail sales, we've got full employment, so it looks like they have room. Philip, talk to me about the bond market, because it's very interesting right now, and we tend to forget that the bond market is actually much bigger than the stock market. How are you reading it?
It's a great question, and you're right. It has been a very interesting environment for the bond market. I would say for many investors, it's been a disappointing environment for the bond market. We have global bonds. The global bond index is down about 6.5% in US dollar terms. The Canadian bond index, the FTSE Canadian Universe overall index, is down 7.5% year to date. These are not returns that you would expect out of the fixed income markets. It's supposed to be that safety area in our portfolios that provides a nice, slow, steady rate of return over time and acts as ballast to the equity markets within our portfolios should there be equity market volatility. Well, that hasn't been the case. We've seen equity markets down. We've seen fixed income markets down. We need to understand the why, what's going on. And it is all a function of higher inflation driving central banks to push interest rates higher, and the bond markets are pricing that in. The challenge is that we came from such a low level of yields in this country and in the United States that you really didn't have much of a cushion to absorb interest rate increases before your returns dip negative.
Phil, I'm going to get you to hold your thought because I want to take a quick break and we'll continue this conversation. We'll be right back. Philip, we were talking about the bond market. How is this going to impact homeowners and especially mortgage owners? Because that's, I think that's a big concern.
It is, and we have to think about that in terms of what it means for mortgage rates going forward. So we're at projections are that the Bank of Canada is going to be at a level where interest rates, or anyone renewing a mortgage at the end of this year, will be renewing at a higher rate on a 5-year basis than where they were 5 years ago. And this is likely to be the case over the next couple of years. So mortgage rates are priced off of the 5-year Government of Canada bond. As expectations for the Bank of Canada to raise rates have been priced into the market, that 5-year bond yield has been moving up fairly steadily. What that means is mortgage rates are moving up. And this is a theme that I think is going to persist for the next year to couple of years. Again, it's all tied to inflation, rate expectations. So mortgage rates are going to follow that. So anyone renewing a mortgage this year is going to likely see a higher rate, higher renewal rate than where we were 5 years ago. Same thing next year. And as we go into 2024, that could be the case. So basically means mortgages are becoming more expensive.
I want to switch gears and talk about the markets. How are you reading the TSX and the S&P? And I guess what everyone wants to know is there a safe place to kind of park your money, especially when you see bonds reacting, the same way equities are? We're not seeing them being more uncorrelated, I guess, if that's a way to explain it.
Yeah, equities and bonds have been highly correlated this year. When they're both down, right, where do you go? The interesting thing is the Canadian stock market has been a great beneficiary of the inflation that we've seen. Why is this the case? Well, energy prices going up, oil and natural gas going up. That's good for energy stocks, the energy sector. When you see gold moving higher, whether it's on a risk-off move or it's due to the just inflation, using gold as an inflation hedge. When you look at copper prices, when you look at nickel, the materials sector has been benefiting from the inflation. And then the financials have been benefiting from the higher interest rate environment. Financials, the banks in particular, do well when interest rates are rising. So the Canadian stock market has been the bright spot as far as the global equity universe is concerned. It's positive year to date. It didn't see the same correction that we saw in the United States or Europe or other areas around the world. So that's actually been one of the best places to invest. And going through the remainder of 2022, I think it'll continue to be a very attractive place to invest. Now, when you talk about where do investors go for perhaps a safe haven, we need to look back in history for this. When we're in a period of higher inflation and rising interest rates, so as we've seen, bonds aren't necessarily a great place to be from an income perspective and also from a safety perspective. Well, one of the lessons that we've learned in the past, you have to go all the way back to the 50s for this, but dividend growing stocks are a great way to maintain current income, see that income increase in an inflationary environment, and protect your wealth as stocks actually tend to do well with inflation.
Okay. What about your suggestion for those who are heavily weighted towards techs? It's been interesting, right? We saw valuations, sky high, and now you've seen a massive sell-off, and it doesn't feel like many of the tech plays have been spared.
No, this is where the NASDAQ, we saw a full-on bear market in the NASDAQ. The NASDAQ 100 fell by more than 20%. Now, it has recovered more than half of that But as you point out, tech companies are expensive. They remain expensive. Yeah, this is an area of the market that you could see further headwinds. And the reason for that being is high valuation stocks, if we look at it on a PE basis, they tend to bear the brunt of rising interest rates and higher inflation because the future earnings are being discounted at a heavier rate than a company that is fairly mature and fairly stable. So I think that the tech sector could still see some headwinds, could still see some downside. It's an area at the beginning of the year that we were less enthusiastic about. And even with the correction that we've seen, or the bear market, the shallow bear market that we've seen, that doesn't change my view that this is an area of the market that is prone to more downside going forward.
Okay, and then are they able to pass on costs? We only have about 15 seconds, but are tech plays typically, are they able to pass on some of the inflationary problems?
Well, yeah, it depends on the tech company. If you look at like a Microsoft or an Apple, these are great technology companies. Facebook, the same thing, that could stay ahead of inflation. These companies aren't overvalued in my view. Yeah. It's the ones that are trading at 60, 70, 80 times earnings that I think are going to face the most headwinds.
Okay, we'll be right back. Welcome back. Philip, it feels like there is this new world order underway. There's a lot of people talking about it, especially given the conflict between Russia and Ukraine, and obviously NATO being involved and everyone else. And we don't know how it's going to play out. In my mind, I think China is still a wild card. I think they're paying attention to this very, very carefully in how the West actually handles it. What are your thoughts?
Well, I think you're right in terms of economies rethinking their partnerships, and not only just with the conflict in the Ukraine and the impact on food, like think about wheat and think about oil and natural gas, and I'm thinking in particular Germany's dependence on Russian energy.
Right.
It's a risk to Germany, and one that I think they're very quickly realizing. But beyond that, let's look at what has happened over the last 3 years with some of the lockdowns during COVID, and even ongoing today as China shuts down Shanghai or Shenzhen. The dependence of one economy on another economy is raising the issue of, is this a good thing or is this a challenge, and what do we do going forward? So I think economies, governments right now are very much rethinking their interdependence on other countries or other economies for various things, whether it be the supply chain, whether it be energy. And I think, to your point, the new world order is going to be perhaps much more nationalistic. The U.S., what they can do to protect their economy internally.
Yeah, and I think that's the interesting point, isn't it, Philip? Because, are we going to see a shift towards more protectionist policies and this focus on self-reliance, and like you said, or mini alliances, or do we need to rethink really how we're diversifying, or I guess maybe the lack of diversifying our needs? Because we haven't done a good job. I don't know any country that really has done a good job on that.
No, and I think coming back to the European example of the dependence on Russian natural gas, for example, they're going to have to build in redundancies or diversify their sources of energy. Countries are going to have to diversify their sources for supply chains, diversify their sources of base metals where they can, just so that if one fails, or if you realize you don't want to be in bed with this bad actor, you can move on elsewhere easily with as little disruption to your economy as possible.
What do you think this means for Canada? Do you see an opportunity for us?
I do. When you think about it, right now, you look at what Canada produces, it's very similar to what Russia and the Ukraine produce. And so Canada could be an alternative to some countries that are too dependent. But we have to have the infrastructure. Natural gas, I think, is the biggest challenge that we have. LNG, liquefied natural gas, it isn't at that point where one country can say, well, if we'll just turn it off from here and pick it up from here. But eventually we can get to that point, and Canada, as being very resource rich, I think could benefit from some of this potential diversification that we see going forward.
Okay, we have about a minute left until the end of the show. What do you think this could all mean for the U.S. as a reserve currency? A lot of chatter about that.
There is, I think it's early yet to think about the U.S. dollar being replaced as the reserve currency. What you need from a reserve currency is I would say, somewhat of a stable government, but a free floating currency. Thinking of maybe using the Chinese renminbi as the alternate, I don't think is a realistic solution because it is still a controlled currency in terms of its foreign exchange. The Swiss franc, I don't think there's large enough of a float. When you think about it, approximately 50% of global trade is done using the US dollar. So it's going to be difficult to replace that with a currency that people have confidence in, that it's free to float given the interest rate environment and economic environment as the US dollar is today.
Yeah, it'll be interesting to see if they look at a basket, because there was talk about that years before.
Potentially, how you manage that, I think, is going to be a little bit more difficult in terms of the makeup of that basket. How much of it is going to be the yen, the Swiss franc, the U.S. dollar, Canadian dollar? Who knows? But it's a while yet before the U.S. dollar will be replaced as that reserve currency, and what it will be replaced by, I don't know.
Okay, Phil, it was great to have you on today. Thanks so much
pleasure
for your insights. Philip Petursson of IGM Financial. Well, that wraps up this edition of Strictly Money. You can catch previous episodes on the show on thenewsforum.ca. And if you have any questions or feedback on the show, drop us an email. Until next time, stay well, stay wise, and stay wealthy.